Okay guys, so today I just had to talk a little bit impromptu because there was this really important article that came up. Vanguard released its 2025 Economic and Market Outlook, which had some really interesting advice to its investors, and I wanted to talk about that. So first off, what is Vanguard? For anyone who doesn't know, Vanguard is the largest stockbroker with over $9.3 trillion in assets. So that means that they are the biggest place for people to invest in stocks. A lot of people use this to invest for their 401ks, their IRAs, or just for their brokerage accounts. And every year, Vanguard will release their economic and market outlook, which is basically them thinking about what the markets are going to be doing for the next year and also for the next decade. And this year is very interesting and maybe a little bit alarming, depending on how you think about it, because there is some really interesting things that they told people to do, especially when it comes to stocks. First of all, Vanguard talked about inflation, because inflation was a really hot button topic for the past few years, and even still, it's something that is affecting a lot of people. Globally, inflation is nearly back to normal. While many markets were harmed by this, they said that the US is in a really unique position because it actually was not harmed by the really harsh policies to try to bring down inflation. So what a lot of countries did to bring down inflation was to bring up their interest rates. We saw that with the Fed raising interest rates really high. And while a lot of countries saw some economic downturn because of this, the US is in a unique position in that it still has some really strong economic growth. And while you think this might be positioning the US to be really strong for the future, this is going to lead into their advice about what to invest in. Because remember, because our economy is still strong, that means that our stocks are still valued very highly. The Fed also has not lowered the interest rates back down to the 2% or lower that we've seen before 2020. And they called this higher for longer. We saw that the market did not like this. And usually whenever Jerome Powell says he's not going to lower interest rates, you can see the market tank. And whenever people think that he will lower interest rates, we see the market start to rise. So we see that everyone, at least in the stock market side, really wants the rates to go as low as possible. Vanguard also talked a lot about supply side factors mattering a lot for the future of valuations, which basically means how fast stocks are going to rise in the next 10 years. Vanguard believes forces like labor markets, productivity, and supply chains will play a big role in shaping economic conditions. A lot of this report was basically singing the praises of bonds. Vanguard sort of heralded the return of the, quote, sound money era, and sound money basically just means what they said is positive real return rate, which basically means that you don't lose money due to inflation holding bonds. There was a time when bonds were paying such a low amount, like maybe like less than 2%. If inflation was greater than 2%, you were actually losing real money by holding a bond. Sound money is when you are gaining money by investing in bonds. So yeah, the Vanguard president is like a huge fan of this. He said this was like the best economic development in the past 2 decades, which is wild, but I guess he really, really, really likes bonds. Vanguard in this outlook said that they do not believe that we'll see a return to the ultra-low interest rates of the 2010s. So for everyone waiting for those 2% loans for housing, at least in Vanguard's point of view, we will not get that back anytime soon. So all this talk about bonds, all this talk about higher interest rates, all this is to say that bonds will continue to pay a steady amount, because as high interest rates exist, bonds usually are pegged to the interest rate. So if interest rates are high, bonds pay out a high percent. And because Vanguard believes we'll see a high interest rate for a long period of time, Vanguard believes that bonds will pay a pretty steady amount indefinitely. Now, from bonds to stocks, Vanguard has a much more bleak picture of stocks, specifically US stocks. And this is where things get really interesting. So Vanguard, their main argument is that US valuations are elevated, and they're far too elevated in Vanguard's opinion. Basically, that means that the stock market is too high. These companies are not worth as much as people are buying them for. Quote, the market has been increasingly concentrated towards growth-oriented sectors, such as technology. And this is a major downside, as Vanguard states, because the growth for these technology sectors is already priced in. Investors already have assumed these companies will grow. And so when they do, that's not going to raise their prices. Things like Nvidia, things like Meta, things like Google. When Google grows, That's an assumption that these investors have already assumed, and that's why they're so highly priced. They're not highly priced because of the money they're making now. They're highly priced because the investors imagined a probable future where these companies are going to make tons of money. And if those companies don't hit those very sometimes optimistic futures, then we will see these companies start to tank in price. I think a great example of this is when Netflix had that one quarter when they didn't have more subscribers than every previous quarter. Remember, they kept increasing subscribers every quarter. Netflix had one quarter when they didn't increase subscribers. Their valuation was slashed in half. It was wild. This is where it gets really crazy. Vanguard gave an updated 10-year annualized return projection. And this is basically what they think people are going to get returns on for different types of assets they invest in. For bonds, both global and US, Vanguard assumes 4.3 to 5.3 annualized return. So you can think of every $1,000 you invest, you would assume you'd get about $50 a year back in growth. This makes sense if the interest rate is about 5 to 6%. Next is the global markets. For global equities, which is stocks, besides the US, in developed countries, they think a 7.3 to 9.3% return, which is quite high. It's about an 8% average. Global equities in emerging markets, they think it's about a 5.2 to 7.2%, so about a 6% average return. And then finally, the thing that's really interesting, and the thing that made me want to do this video, is US equities. They think that the average 10-year annualized return is going to be 2.8 to 4.8. That's an average of about 4%, maybe a little bit less than 4% a year for US equities. And this is wild because if you look at it from best to worst, US equities is in dead last. So Vanguard is saying that the worst thing you can invest in as a category is US stocks. If the choice is between US bonds or US stocks, Vanguard is saying do not invest in stocks. The largest stockbroker just told customers to not invest in stocks for the next 10 years. And that is absolutely wild. Remember, the reason they're saying this is because of all the reasons I already talked about. They're saying that the valuations of US are severely inflated. They're saying that the growth sector is because all of this is already priced in. And they're saying that bonds are going to be much more consistent. They're also saying that because the US didn't have that sort of downturn, that means that we didn't have prices lower, which means that prices can't rise again. So this is quite alarming, especially because I think most people default to investing into US stocks. I think for most people's retirement portfolios, the default is either throw in the S&P 500 or throw it into the US total stock market. And so for the largest stockbroker to advise its investors to not invest in US stocks, this is something that can be alarming. And I think it's something that you really want to figure out, what am I going to do about this? So what should you do? There are two ways to look at it. You can either take Vanguard's word or you can not take Vanguard's word. So let's figure out what we should do. If you take Vanguard's word, then you should invest heavily in global stocks. You should invest moderately in bonds, either global or US, and only lightly invest in US stocks. And we can talk this out and see the reasoning behind this. And there are several really smart reasons to invest more lightly in US stocks going forward. Everyone is saying that US stocks are overvalued and have been overvalued for years. If you think about companies like Meta, Google, Amazon, all these new AI companies, a lot of times you see these prices and these companies are worth billions and trillions of dollars, and then you see what they output and it just doesn't seem to match up at all. The AI bubble, in a lot of senses, can feel like that dot-com bubble of the 2000s, where it just feels inevitable that all this money pouring into all these AI companies is at one point going to burst. And that means that, like we saw in the dot-com bubble, the stocks are going to tank as soon as that happens. We saw a really tiny example of this just a little while ago with the DeepSeek AI scare. That wiped billions off of stock companies. That really wasn't even an actual company. That was a side project of a Chinese company. Most AI companies aren't profitable yet, but investors are pouring billions and billions into them. There's also everything else going on right now. The cost of living for many Americans is rising faster than manageable. There's so much that inflation is still affecting with. I mean, the price of eggs right now is insane. There's a housing crisis. Many in the younger generation are having trouble trying to buy a house and having to give up on their dream of a house or going into debt to do it. There's intense weather events happening more and more frequently that are going to be extremely costly to fix. And moving forward politically, there seems to be an increase in trade wars and tariffs, which can also affect the economy in obvious ways. So in some senses, a recession feels inevitable, but all the while, stocks have continued to rise. The stock market, for many, has felt disconnected from reality for years, and a major correction feels like it has to occur at some point. So by following Vanguard's advice and not investing in US stocks or investing less in US stocks, you are trying to protect against all this. However, should you take Vanguard's advice? As the economist John Maynard Keynes once said, markets can remain irrational longer than you can remain solvent, which basically means that just because it seems like the wrong decision to invest doesn't actually make it the wrong decision. I think a good place to start dissecting Vanguard's opinions is by looking back at their history. Has their advice been consistently strong, and should we follow their advice based on their past? So in 2017, this is what they said in a similar market outlook report. They said that bonds would pay on average 1.5 to 2.5% annually, and that global stocks would pay 5% to 8% annually. So these numbers seem interesting, and they were, at the time, much less than the average. And when we look at reality, we see that what they predicted and what actually happened are actually two completely different things. Global stocks over the last 5 to 10 years have paid over 8%. Most years, they have paid well over 8%. And global bonds actually paid under the 1.5% that they predicted. So we see that Vanguard might be having a history of undervaluing stocks and overvaluing bonds. In 2015, they said, quote, although not bearish, Vanguard's outlook for global stocks and bonds is the most guarded since 2006, given compressed risk premiums and the low rate environment. This basically means that they were really cautious about investing in 2015, both in stocks and bonds. And if you remember, 2015 was right before the start of one of the longest bull runs in history, where stocks just went on an incredible rise. So if you had sat that out, you would be missing out on just insane amounts of gains, especially if you kept all that in cash. I mean, money would have doubled if you just invested it. I would love to be able to sit here and tell you what exactly to invest in to make the best returns in the next 10 years. But no one has a crystal ball. Not even Vanguard, with their team of experts making 30-page PDFs every single year. For your own personal wealth building, steady and diversified investing will always be the best. I'm not even going to say always. For your own personal wealth building, steady and diversified investing will usually be best. Timing the market usually doesn't work out in people's favor. Broad-based ETFs, whether they're global, US, or international, help to protect from individual companies' performances, especially if they have a bad year. So while Vanguard's outlook is really worrisome and can make people consider if they should change their whole entire investment strategy based on their past history, it doesn't seem like they always have gotten it right. We'll have to see what the future holds, but for right now, I don't think I'm going to be 100% changing how I invest just based on this one report. Okay, so thank you so much for this impromptu video. Hopefully that was helpful. I know that, these times can feel very unprecedented and very worrisome. So I just wanted to chat it out with you guys. Please like, comment, and subscribe. Thanks so much. Bye.